Module 3, Income Measures. Adjusting Entries. Adjusting entries affect both the income statement and the balance sheet accounts. Adjusting entries are made at the end of an accounting period to update the accounts for transactions that have occurred but have yet to be recorded. These entries ensure that the financial statements accurately reflect the company's financial position and performance for the period. Adjusting entries can affect both the balance sheet and income statement accounts. For example, an adjusting entry to accrue an expense will increase the expense account, an income statement account, and the liability account, a balance sheet account. Similarly, an adjusting entry to record depreciation expense will decrease the asset account, a balance sheet account, and increase the depreciation expense account, an income statement account. Adjusting entries can also affect other income statements accounts, such as revenue and tax accounts. For example, an adjusting entry to record unearned revenue will increase a liability account, a balance sheet account, and decrease the revenue account, an income statement account. In summary, adjusting entries ensure that the company's financial statements accurately reflect its financial position and performance. They can affect both the balance sheet and income statement accounts, depending on the nature of the adjustment. Profit margins. The statement profit margin is not a useful measure of a company's operating results is inaccurate. While profit margin may not be the only or most comprehensive measure of a company's operating results, it can still provide valuable insights into the financial performance of a business. Profit margin is a measure of a company's profitability that indicates the profit generated per dollar of sales revenue. It is calculated by dividing the net income by the total revenue and expressed as a percentage. A high profit margin indicates that a company generates a significant profit relative to its revenue. In contrast, a low profit margin suggests that a company struggles to generate profits from its sales. While profit margin provides essential information about a company's financial performance, it is not a complete measure of operating results. It does not account for factors such as cash flow, capital expenditures, or debt levels, which can all impact a company's financial health and sustainability. Furthermore, accounting practices and other factors that may not accurately reflect the company's operating performance can influence the profit margin. For example, a company may have a high profit margin due to aggressive accounting techniques that inflate its revenue or understate its expenses. Therefore, it is essential to consider multiple measures of a company's operating results, including cash flow, return on investment, other financial ratios, and profit margin. Investors and analysts can better understand a company's financial health and performance using a range of metrics. Adjusted entry office supplies. Here's an example of an adjusting entry to record unused office supplies. Debit to office supplies expense or $254, which is $359 minus $105. Credit to office supplies of $254. The office supplies account had a debit balance of $359 prior to the adjusting entry, which indicates that the company had purchased $359 worth of office supplies over time. However, after conducting a physical count, it was determined that only $105 worth of supplies were used. This means the company still has $254 worth of unused office supplies. We need to debit the office supplies expense account for $254 to adjust the accounts for this difference. This reduces the office supplies account's balance to reflect the amount used and recognizes the expense related to the unused supplies. At the same time, we need to credit the office supplies account for the same amount to show that the company still has $254 worth of supplies on hand. Adjusting entry insurance. Let's say a company paid a $2,400 premium on July 1st for a one-year insurance policy. The policy will cover the period from July 1st to June 30th of the following year. Since the company's year-end is on December 31st, the policy would have been in effect for 6 months during the first year. Therefore, the insurance expense on the annual income statement for the first year ended December 31st would be calculated as follows. Insurance expense equals total premium divided by total coverage period times coverage period during the year. Or, insurance expense equals $2,400 divided by 12 months times 6 months. This makes the insurance expense $1,200. Therefore, the insurance expense on the annual income statement for the first year ended December 31st would be $1,200. Wages payable. Wages payable is a current liability account representing the money the company owes its employees for work performed but not yet paid. This account records the wages, salaries, and other compensation the company owes to its employees as of the end of an accounting period. Wages payable is typically recorded as an accrued expense through an adjusting entry at the end of the accounting period. This means that the company recognizes the expense and the liability for the unpaid wages as of the end of the period, even if the payment will not be made until the next accounting period. For example, suppose a company has a bi-weekly payroll and the accounting period ends in the middle of a pay period. In that case, the company will need to estimate the wages owed to employees for the remaining days of the pay period and record this amount as a liability in the wages payable account. When the company pays its employees for the work performed, it will debit the wages payable account and credit the cash account to reflect the payment made. This will reduce the balance in the wages payable account and remove the liability from the company's financial statements. The monthly accounting period ends on Thursday, and the company pays its employees $4,000 each Friday for the 5-day workweek that begins on Monday. This means that the employees worked for 4 days in the current accounting period, Monday through Thursday, and 1 day in the next accounting period, Friday. To calculate the number of salaries earned but unpaid at the end of the accounting period, we need to determine the total amount of salaries earned by the employees for the 4 days worked in the current accounting period. Let's say employees earned $800 per day for the 5-day workweek, so for the 4 days worked in the current accounting period, they earned $800 per day times 4 days equals $3,200. Therefore, the salary earned but unpaid at the end of the accounting period is $3,200. This amount represents the company's obligation to pay its employees for the work performed in the current accounting period, which will be recorded as a liability in the wages payable account. Adjusting entries. An unadjusted trial balance is a report that lists all the accounts of a company and their balances before any end-of-period adjustments are made. An unadjusted trial balance ensures that the total debits equal the total credits and identifies errors in the general ledger accounts before adjusting entries. The unadjusted trial balance is typically prepared at the end of an accounting period, such as at the end of the month or year-end. It includes all accounts with a balance, whether they have activity during the period. Once the unadjusted trial balance is prepared, the accountant can review the balances in each account to identify any errors or omissions. For example, if the unadjusted trial balance shows that the total debits exceed the total credits, this could indicate that a transaction was recorded incorrectly or that an account was omitted. After reviewing the unadjusted trial balance, the accountant can adjust entries to record any accruals or deferrals during the accounting period. These adjusting entries are used to update the account balances to reflect the correct amounts for the end of the period. Once the adjusting entries are made, a new trial balance called the adjusted trial balance is prepared. The adjusted trial balance shows the updated account balances after the end-of-period adjustments. The closing process. The closing process is a series of accounting steps a company follows at the end of an accounting period to prepare its accounts for the next period. The primary purpose of the closing process is to ensure that the company's accounts accurately reflect its financial position at the end of the period. One of the critical steps in the closing process is the closing of temporary accounts, such as revenue, expense, and owner withdrawal accounts, into the owner's capital account. This is necessary to ensure that net income or loss and owner withdrawals for the period are closed into the owner's capital account. At the end of the accounting period, all temporary accounts are closed to the owner's capital account. The revenue accounts, which represent the company's income for the period, are closed into the owner's capital account to show the increase in the owner's equity. The expense accounts, which represent the business costs for the period, are closed into the owner's capital account to show the decrease in the owner's equity. The owner withdrawal account, which represents the withdrawals made by the owner during the period, is also closed into the owner's capital account. This ensures that the withdrawals are correctly accounted for and that the owner's equity is adjusted accordingly. Once the temporary accounts have been closed, the owner's capital account will reflect the net income or net loss for the period and any owner withdrawals made. The balance in the owner's capital account will then be carried forward to the next accounting period, which will be used as the starting point for the next period's financial statements.